Ladies and gentlemen, good day and welcome to Havells India Limited earnings conference call hosted by Prabhudas Lilladher Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amnish Agarwal from Prabhudas Lilladher Private Limited. Thank you, and over to you, sir.
Hi everyone. On behalf of Prabhudas Lilladher, I welcome you all to Havells India conference call for 2Q FY21. We have with us the top management of Havells India, represented by Mr. Anil Rai Gupta, Chairman and Managing Director, Mr. Rajesh Kumar Gupta, who is Director of Finance and Group CFO, and Mr. Rajiv Goyal, who is Executive Director. Now I hand over the call to the management for further proceedings.
Thank you very much. Good afternoon, everyone. Welcome to the earnings conference call for the quarter ended September 2020. Hope you would have reviewed the results by now. So for my initial remarks, I would say COVID-led disruptions seem to be declining. We are encouraged with the pace and extent of demand recovery. Consumer and residential demand especially is robust. However, industrial and infrastructure sales remain sluggish, though they are also trending towards a gradual recovery. Our initiatives in rural, online and channel engagement have well delivered. Lloyd recovery is led by AC sales growth. Recent entry into refrigerators would further strengthen the product portfolio. We perceive the recent impetus to Atmanirbhar Bharat with prohibition on AC import as positive for integrated manufacturers like Lloyd. Advertisement spends and capex remain low during the quarter, though we expect a gradual recovery to normal levels. The festive season seems to be evolving decently, though COVID development needs to be observed for sustenance. There is a positive sentiment amongst the entire organization for growth, and we continue to build on the momentum. We may now proceed for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Akhil Tiwari from Citigroup. Please go ahead.
Yeah, thanks, sir. This is Atul here from Citi. So my first question is on the margins this quarter. So congrats on very strong margins of about 70%, which seems to be driven primarily by raw material to sales ratio, which is quite low. So is it sustainable, this 17% kind of margin, or 400-500 basis point higher than what you normally report?
So on the margin front, if you see, we've also reported the contribution margins, which have either remained constant or have improved. Especially they've improved in the lighting and ECD segment, but also have remained quite stable in the other segments also. So we believe that these margins would hopefully remain sustainable, though there is a pressure on the commodity prices, which might take a little bit of lag to pass it on into the market, and hopefully things should ease out in the coming times also. But our focus usually is on the contribution margin and to keep expenses under control. Now you see in this particular quarter, there were certain expenses which were lower than normal, like the advertising spend, so which over a period of time will come back to normalcy. So I believe the contribution margins have the ability to sustain, and we will continue to build volumes to retain as much as of the overall margins. However, some of it may come off because of the increased expenses.
Okay. But so what about raw material to sales ratio or the gross margins? Because a lot of this EBITDA margin improvement appears to be driven by that in this quarter. So will that sustain?
So I think, we look at the contribution margins. Contribution margins have primarily remained either equal or better than last quarter. So that is where we are striving for. All the cost initiatives in the factories, productivity improvements are working towards that.
Okay, sir. And sir, my final question is, any comments regarding the outlook for second half, and especially how are things during the festival season?
Well, what we've seen in the last quarter, I mean, the outcome has been positive. When we entered the quarter, we didn't expect that the consumer and residential demand would come back so strongly. So hopefully this should sustain the festival demand. We are a couple of our product categories like domestic appliances and lighting cater to, and some part of Lloyd as well. But generally speaking, we look at the overall recovery in the economy, and that hopefully is sustaining even after the end of the second quarter. So hopefully, I think we should be looking at better times going forward.
Okay, thank you. Thanks a lot.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity and congratulations on a great set of numbers. So I have two questions. The first related to the key strategies or the initiatives that the company has undertaken, which has helped us with delivering such a strong performance. And secondly, market share gains. So in Q1 conference call, we had talked about market share tailwinds from the unorganized sector. So have we gained market share in any of the categories in this quarter, and do we see sustainable market share gains going forward as well?
So I think if we talk about broad strategies, I think in any crisis situation, some strategies are immediate, and some things are taken forward from the past. So our focus on the channel, our deeper entrenchment of the distribution channel, that continued to remain as well as intensify during the pandemic time, the COVID time. So our connect with the channel definitely paid off results. Our initiatives in going deeper into tier 2, tier 3 towns and the rural markets, that helped the focus on online. And so being an omnipresent channel kind of a company, that really helped during this time. So plus overall looking at all good costs, bad costs, good costs which can go temporarily and come back, bad costs which can go away permanently. I think a lot of focus was put on improving the cost efficiencies into the organization, and obviously looking at newer growth opportunities for the future. We believe, definitely we have taken market share gains in all the product categories, and that's what's something which is very satisfying. And unlike in FMCG industry, it's very difficult to get month-on-month numbers on the market share. Maybe we are not big fans of the market share reports of, because our industry is not well covered that way from whether you see switchgear or cables and wires from a market share point of view. But what we can find out is how the competition, the organized competition is faring as well as the unorganized competition. Definitely in the last 6 months, because of supply chain disruptions, because of change of mindset of both the consumer and the channel, we have seen market share gains from the unorganized channel as well. But over the last few weeks or months, we have also seen market share gains in many product categories from the organized manufacturers as well. So I think that is what is more satisfying, that this growth is coming not only on the growth in the economy, but also on growth in market share numbers.
Understand. Sir, and how much of your business would be B2B or infrastructure related right now? And secondly, any quantification in terms of deepening of rural reach right now for us?
Yeah, so we estimate that our industrial, so again, many of our consumer and residential product categories also go into industries and infra. So, but we have now started defining into two different broad segments, which is both more consumer and residential oriented, and the other one is infrastructure and industrial oriented. The products which go into industrial infrastructure related, they are contributing about 25% of the overall sales, and there we have seen sales even lower than last year. Whereas the consumer and residential, we have seen sales grow at about 15% or so in this particular quarter. So that's very satisfying. And I think going forward, the way we've started looking at the last few weeks, the infra and industrial segment has also started coming back. I think hopefully things should start normalizing in the next couple of quarters.
Sure, sir. And any quantification of your rural reach, which you think is sustainable?
Well, our rural reach is deeply intensifying, and we've seen almost 140% growth in rural sales in this particular quarter. Though the number is small, but now we can say that almost 4% of our consumer and residential sales is coming from the rural areas.
Fair enough. And my last question, any views on the real estate demand returning and any capex guidance? That's it from my side.
So yes, as I said, consumer and residential, we've now started clubbing into one. So we are seeing some improvement in the residential demand as well. In fact, within the cable and wires, if you see, our domestic wires business grew around 19 to 20%. So that is an indication of improvement in the residential demand as well. And as far as capex is concerned, when we started out the year, we looked at the entire year because the COVID things had happened. We had contracted our capex, but now we have revisited our capex, and this year it seems we should be in the range of about 330 crores or so for the entire year.
Sure, sir. Thank you very much.
Thank you. We would request the participants to please press star and 1 to ask a question. The next question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah, good evening, sir, and congratulations for a very strong performance in this quarter. So, as in you did mention different aspects of the market and growth. What part of the demand aspect you think could be having some element of pent-up demand, or do you think the broad contours of the growth look very much sustainable for us? On the demand side, how does that look in terms of the growth that you secured this quarter?
So, Renu, it's difficult to say, even after 4 months of or 4.5 months of lockdown opening up, whether pent-up demand would be there. Things would have normalized by now, but we definitely feel that the inventory levels in the trade are lower than last year, than the normal levels. So, which does indicate that there might have been some pent-up demand. But overall, we believe that the economy pickup has been better than what we were expecting.
Sure. And second would be, sir, again, you did mention during your comments growth of 19-20% in the housing wires and other categories. If within some of the large categories, can you throw some insight in terms of the performance? Because overall ECDs grew 18%, others grew. So within them, some feelers in terms of the large categories, how did they perform? And overall, should we expect this kind of market share gain to be sustained as the rest of the market comes back to normal towards the second half of the year?
Generally, because we have so many different business units within the segments also, so it's very difficult to get, go specifically talk about one product segment or the other.
But as I said, highlights or the outlier growth which you think?
Yeah, so as I said, overall, if you see the consumer and residential sector grew in mid-teens. So within that, if you see, lighting as a overall thing has grown by only about 4 to 5%. But if you take out the professional luminaire business, which is also related to industrial infra, the consumer lighting business has grown around 15%. The ECD overall has grown around 18%. We believe within that also, if you look at the large product category like fans, we have grown fastest in the market. Not only we have taken share from the unorganized sector, but we believe that we've grown faster than the competition in the organized sector as well. So there is, I would say large segments. There are large segments in the industrial infra where we still have to come back to sales levels of last year, but definitely in the residential and consumer, we are seeing good traction.
Sure. And sir, two follow-up questions on the cost structure. I think we had taken various cost actions. So are we now seeing some of these fixed costs being restored back, be it in terms of employee benefits and other details? At the same time, on the ASP spend, last quarter you mentioned there could be a structural cut down in terms of the spend which you were traditionally doing of almost 4.5% levels. So should we see those levels now tapering to 2.5-3% at the company level, or they should, in your view, now come back to the previous or pre-COVID levels the way we were spending earlier?
Well, as I said, we looked at the entire cost structures of the company, and we definitely don't want to curtail any expenditure which is the required infrastructure. In fact, on the employee expenses, we had actually not taken any salary cuts in the first 6 months. So I believe the employee expenses are the sustainable expenses, except something whether it's related to growth and employment, there would be only an increase. Otherwise, those are sustainable expenses. Some of the costs will come back. Like travel costs are still very low. They will come back. Advertising and promotion spends will start increasing in the third and fourth quarter. It will take time to go up to the normal levels, or will never go back, because as I said, there are structural changes, but it will gradually step up. So we'll not see an immediate rise, because brand building for us is more of an investment. It's not something which is related to impulsive buying, as in some FMCG categories. So it's more of a brand investment, and I think we'll continue to see how the monies are distributed between digital and non-digital spends. So I think over a period of time, this will come back to normal levels and may not be the same levels as pre-COVID levels.
Sure. Thank you so much, and all the best, sir. I'll come back in the queue with more questions. Thank you.
Thank you.
Thank you. We would request the participants to please press star and 1 to ask a question. The next question is from the line of Vishal Biraya from Aviva Insurance. Please go ahead.
Hi. Sir, in terms of the supplies from China for a small appliances business, how is that shaping up, and what is the market share currently in the small appliances business, or kitchen appliances and other stuff?
Well, from a China point of view, we are not dependent upon China, because almost 75% of the products we manufacture in-house. Some of the products are sourced within India. So our dependence on China for small domestic appliances is extremely low, and so that should not be a concern. Our market shares are still low in terms of kitchen appliances, which clearly indicates a huge opportunity for us to grow in this segment. I would say that our market shares would be close to about double-digit levels, about 10 to 11%.
Any specific actions that we are taking for growing this market share, and something specific for this other than normal?
Well, there's a constant improvement in the product ranges, the features, and enhancement of the distribution presence all across. So there's been a decent growth in this segment, because of all these strategies.
Okay. And next question is on the e-commerce proportion for us. Up to this quarter, did we see an increase in e-commerce sales, and how is our profitability in e-commerce versus general trade and modern trade?
Well, we did see a major increase in e-commerce sales. In fact, now it has come to almost about 4.5% of consumer and residential demand. So that's quite strong. And going forward with Lloyd now focusing on the e-commerce channel along with the traditional channel also, that should keep increasing our share in the e-commerce. Consumers have also taken to e-commerce very well. So it's grown almost 100% in this particular quarter in the e-commerce thing. And profitability is not really a concern, because we don't play on pricing. Our pricing to various channels are similar, depending upon the cost structure. So we are not too concerned about the profitability in one channel or the other.
Okay. Thank you. And just one last question on the refrigerator market, on the RAC market, as to what led to this stupendous growth in this quarter?
No, I think it's merely a comeback from our, I would say, dismal performance last year, because as we had made certain corrective actions in distribution, our product ranges, our brand perception over the last couple of years, so we had lost market share in the last year. I think it's a comeback from that position, which we always knew that it should happen, and probably we just need to look at overall growth over the last 2-3 years rather than growth from last 1 year.
Would we have cut prices to compete and get this volume, or would we have given higher incentives to the dealers or better working capital terms, something of that sort?
No, in fact, our credit terms are quite well disciplined right now. So in fact, post-COVID, our credit days are better. In fact, we've not cut down prices. Our margins are better than last year. So I don't see any reason why we would need to do that.
Okay. And do you think this momentum should continue for RAC market share growth?
Let's see. As I said, this is also predicated on the fact that we had last year first 6 months were quite slow for us. Let's see how it pans out in the coming time, and especially the season time.
Fair enough. Thank you very much, sir.
Thank you. We would request the participants to please limit your questions to 2 per participant. The next question is from the line of Bhumika Nair from IDFC Securities. Please go ahead.
Yeah, good evening, sir, and congratulations on a great set of numbers. So just wanted to dig a little deeper into the B2B segment, which you highlighted has seen some decline. If you can just kind of explain which segments have seen a sharper decline, and is it a single-digit, double-digit kind of a number? And how are you seeing this kind of scale up across cable segment, switch gears, as also B2B lighting?
Yeah, so industrial switchgear, professional luminaire cables comprise our industrial and infra. So, overall we're at about 85 to 86% of last year in industrial and infra. And but this is improving month on month. And, we've seen a sharper decline in underground cables as against switchgears and professional luminaires, which are almost coming back to normal levels in the very recent times. So hopefully, this should also start coming up.
Okay. Secondly is in terms of the price hikes that you mentioned that we've taken in the ECD and the lighting segment. What kind of price hikes have we taken? And my last question is on Lloyd. We've entered into the refrigerator space and we've launched that. So how is that expected to scale up? What kind of market share are we looking at more from a 2-3 year perspective, if you can just throw some light on that?
Well, I didn't mention any price hikes in ECD or lighting, so not sure what we're talking about here. But on the refrigerators part, we are very, very new in this. The whole idea which we've been saying is that our main game in Lloyd would be to become a complete portfolio of consumer durables, basically offer the entire range to the dealer channel and eventually to the consumers. So with the entry of refrigerators, we are now a complete portfolio in the consumer durable, just like in the electrical segment. So we need to see how this develops. We're very hopeful that the demand for this product also will remain strong, and this will contribute to a good set of numbers to Lloyd.
Sure, sir. Wish you all the best. I'll join back in the queue.
Thank you.
Thank you. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, good evening. Congratulations for the great numbers. My question was specifically with respect to the fans business. Just wanted to get your perspective in terms of the industry decline. Have you, in your opinion, is the decline in a single digit, double digit, or is kind of flattish for the quarter? In terms of the unorganized players, are you seeing the supply disruption getting minimized at their end as well?
So, Achal, are we seeing a decline in the fan industry?
Yeah. Is there any decline in the fan industry for the quarter?
No, I wouldn't be able to say that. I think there would be a growth in the industry. But, it's, as I said, it's very difficult to estimate because we do not know the extent of the businesses done by many other companies, including the unorganized sector. But we would estimate that at least there would be a single-digit growth in the fan industry.
Right. And if I look at the employee cost, we see a significant increase QOQ. I understand in the passing remark you did say this is a sustainable number, but just wanted to get a clarification on that. Is this the 100 we should look at going forward in terms of the employee cost?
Yeah, so as I said, going forward, this is the run rate that we need to look at. There will be, because in the first couple of quarters there were no increments. Now there are increments coming in, so there will be definitely this will be higher than in the past.
Got it. This is really helpful, sir. Thank you so much.
Thank you. The next question is from the line of Manish Agarwal from Edelweiss. Please go ahead.
Hi, sir. Congratulations for a great set of numbers. Sir, just would like to get your views on the current government's, the AC import ban. How are we looking at that opportunity? And, are we at an advantageous position? Obviously, we have our own manufacturing, but from even the competitive landscape position and the pricing perspective, if you could throw some light on that.
I think, first of all, if you look at the broader picture, it's a great incentive for Atmanirbhar Bharat because, unfortunately, in this industry, still quite a large part of ACs were being imported from China. And that was something which was we wanted to follow. As you know, when we acquired Lloyd, we immediately decided to set up a manufacturing facility and do away with the import from China. And it's not that the Indian industry cannot become competitive against China. So we need to make the right investment. And I think it's good that the government is realizing that AC is becoming more of a necessity for the consumer, and more manufacturing jobs can be brought about by increasing the manufacturing of air conditioners in India, not only for the growing markets in India, because we believe that AC is an inflection point. I think in the next 5 to 10 years, this industry shall grow considerably with better availability of power. But also it provides a great opportunity for increasing exports. Once you have competitive manufacturing industry, it's great because right now a lot of the world customers are dependent on China. And I think depending upon one country might not be the best strategy for many of the buyers. So India can potentially be that kind of a manufacturer for the world. So I think this is a great forward-looking move by the government.
Okay. Thank you, sir. And sir, basically from maybe the next season for summers, next quarter onwards, the supply would start to the channel. So how do you see us positioning there, from the pricing and the competitive position? Because as you also mentioned, it's a large part of the ACs used to get imported. So in this disruption, do you see us garnering very high market share?
I think it provides an opportunity, but again, as I said, we should not look at this for the next 5-6 months. I think the government intentions are very clear that they want to promote Indian manufacturing. So yes, right now, they prohibited imports for gas charged air conditioners, but it is a clear indication that they don't want 1/3 of the production or 1/4 of the production to be imported from China. So it's the right time. Integrated manufacturers like Lloyd and other manufacturers should invest more in manufacturing in India rather than depending upon imports. So going forward, we made the investment at the right time. We should definitely look at maximizing our capacity utilization in this plant, and hopefully going forward look at more capacities in the coming times. So, but again, as I said, it might be too short-term oriented to see rest of next season.
Okay. Okay. So just last question on this bit, sir. Our margins in Lloyd, sir, since our plant is fully functioned now, so maybe from a 1 to 2 year perspective, any guidance that you would like to provide on, how the margins would pan out?
No, I think margins would definitely improve with more and more production coming from in-house. Right now still certain parts where the plant was fully coming to operation, then suddenly the COVID happened. And then we missed the season impact as well. So going forward in next season, we will really see the major impact of fully operational plant. So we should be seeing improvement in margins in the coming times.
Okay. That was helpful, sir. Thank you.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity and congratulations for great set of results. Just one question. Over the last couple of years, we have seen considerable expansion in our addressable market. So it will be useful if you could just help us in terms of the management level increases that we would have seen, and it would be useful if you could just give some the new entrants where they are managing the newer businesses.
I'm sorry, can you clarify the question? I can't really get.
Okay. So we have seen increase in our addressable market into refrigerators and a couple of other areas. So if you could just highlight the newer management level entry into the company, and in terms of a background also, that will be helpful because we are expanding our addressable market exponentially.
So I would again say that it's not really related to one or two product categories that we've entered into. Whether it's a refrigerator or water purifiers or something that is in addition to our existing channel. But overall, over the last 5 or 6 years, there's been a considerable expansion in management bandwidth at Havells. And we're getting talent from different kinds of industries, not necessarily only from the electrical industry. We're getting a lot of people from FMCG background, telecom background. We bring in different sets of capabilities. Even in manufacturing, we're getting a lot of people from the auto side as well, auto businesses as well. So the great thing about, I can proudly say that it's, we're among the top few companies in the great place to work, that there's a great assimilation of culture and different kinds of people in the organization, with lots of new learnings on both sides and some amount of new unlearnings on both sides also. I think we've been able to assimilate a huge amount of management bandwidth in the last 5 or 6 years. And that has worked very well in terms of, expanding into new categories as well as expanding into new channels.
Sure, thanks. Yeah, one more question, if I may. So when I look at the R&D spend or on the innovation for Havells, and it's twice that of the industry. But when I compare with some of the global peers, which could be a relevant comparison, I mean, some of the global peers could be in the region of about 3-odd%. So if you could just highlight slightly on a longer term perspective, where should one look at the R&D spends, and if you could also include the areas on which we are pushing on our R&D initiatives.
See, R&D creation is not really spending, it's more of a journey, right? So you need to create infrastructure, you need to create the right kind of people in the organization to do real R&D. One is, developing products, but to do real R&D, it is a journey, which we have started. The first phase, I would say about 20 years back, when we wanted to become self-reliant and not be dependent upon European technologies, that phase started. But over the last 4 or 5 years, there's been considerable increase in investment in terms of getting manpower and, to develop newer technologies like, IoT, smart home, electronics into electromechanical products. So there's a considerable investment which has gone into these areas. We have a fully developed R&D center, both one in northern India, but also in Bangalore, which focuses on newer age technologies like smart homes and IoT and all. And so I think going forward, as I said, rather than looking at the percentage of sales, but look at it as a journey that building capability within the organization. You can very well imagine this is an Indian company which is not dependent upon any technology from outside, whether it is high level of switchgear which is being sold not only in India but in many developed parts of the world. We are manufacturing miniature circuit breakers, products which are extremely sensitive, which are being sold in the brand name of Hyundai in many parts of the world. So this is a true testament of what kind of technology development we have done without being dependent on any outside technology. A lot of people ask us this question, whether we'll be able to compete in air conditioners manufacturing in India without any technology backup. Everything is developed in-house, whether it's washing machines, air conditioners, water purifiers. So it does, it's, again, as I said, you can do R&D at a low cost as compared to the global peers, but there will be a cost associated with that always. And this will keep building up. As and when our capabilities keep building up, this investment, I would say, not an expense, will keep building up.
Thank you so much for taking my question. Best wishes, Sumant.
Thank you. The next question is from the line of Chirag Shah from CLSA. Please go ahead.
Yeah, hi. Thank you for taking my question. So over the last couple of years, we have done a lot of hard work to revive the market share and margins in Lloyd's. Can we just spend some time on the progress that we have seen on Lloyd's on the distribution front, the steps that we have taken on the margins and overall growth visibility on how we see now Lloyd's shaping up in the next 2 or 3 years?
Well, I've talked about it in the past also, but unfortunately we didn't have the results to back that up. Obviously, your efforts you put in and the results come later. So hopefully the results have started coming in now. The distribution enhancement. So, just to give you a few examples that we were dependent when we acquired the company, we were dependent upon a few distributors only all across the country. We were not present in the online channel. We were not present in traditional retailers. We were not present in the modern format retail. So today we are omnipresent company in terms of Lloyd's. So complete distribution channel has been revamped in the last couple of years. The brand perception, it was considered more like a cheap product, a good quality product but a cheap product, has also been changed with many new additions of product features, high levels of product quality as well as service. And lastly, on the manufacturing front, with control on supply chain, now we have a better hand on the cost of the product as well. So going forward, on the channel side, on the brand side, on the product costing side, we have a great hand on, I would say, control on. So going forward, we definitely see that there will be expansion both in market share, distribution reach, as well as margins for Lloyd.
Sure. Just a couple of follow-up on that. So if I have to now look at a 3-year view, and is it a good time to now, look at how the product mix would look at in the next 2 or 3 years, given that now we are also getting into newer categories? And also to your point around, the perception of the brand, given the fact that now we have a world-class manufacturing facility in place and we have also added a lot of new features, how are we communicating the same to the distribution channel, and how well accepted is our product quality with the distribution channel in your view?
Well, it's been a tremendous, I would say, 180-degree change in perception in terms of the channel. And you'll be surprised to hear that our factory came up in November last year or October last year, and during that time till about February, almost 3,000 channel partners have visited the facility. So they are very well capable. We have been able to communicate it well, and those are the people who can communicate the attributes to the customers as well. So there's a great communication exercise happening in terms of the channel, and so I don't see that as a concern at all.
Sure. And is it a good time now to start thinking about how the product mix will look like the next 2-3 years, given that we are now also getting into new categories?
In terms of the proportion of sales for different product categories?
Yeah, ACs.
Yeah, so this would not be the right time to comment upon that.
Sure. Thank you so much.
Thank you. The next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
So thanks a lot for taking my question. Just one question. Could you give a sense of what our capex guidance for the next couple of years would be, and any particular segment where that capex is going to go in, particularly given that there is a thrust of manufacturing in India? If you could talk about that.
Yeah, so right now we believe that this year we'll be looking at about 300 to 350. Around 330 crores is the capex plan as of now. Next year, not entering into new plants because we are expanding capacities in our existing facilities also. This number could anywhere be between 250 to 300 crores. But there could be possibilities. We are reviewing of new manufacturing facility for any product category, and that will continue to review depending upon how the market situation improves. So right now we're looking at 330 crores right now. And maybe closer to the end of the year, we'll be able to formulate for the next year.
Sure. Just to clarify, we've done 80 crore in the first half and 330 for the full year is what we are targeting.
As of now, yes.
Okay. That's it. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one now. The next question is from the line of Naval Seth from Emkay Global. Please go ahead.
Thank you for the opportunity. I have two questions. First, if you can share some insights on your O2O model, how much traction we have got, how many distributors we have already reached out, some sense over there. And second, you have elaborated well on the cost structure, where all things have kind of been structural and where things can come back. If you can highlight some large cost items or where savings are structural in nature, if not the quantum, but the head, cost heads where it is structural in nature.
Okay. Sorry, your first question was O2O. Okay. Yeah, O2O model is developing, and we almost have about 1,100 distributors on the platform. The sales build-up is still very slow because we need to get the consumers attracted from the, they're still coming on the large marketplaces. We also need, better attraction tools for the consumers to come on the Havells.com site. But it will develop over a period of time. But we are quite excited about this opportunity where, online consumers can get physical delivery from the physical stores in the neighborhood. So that's one. As far as structural costs are concerned, as I said, these are somewhat these costs related to, let's say more of virtual meetings with the channel partners as against physical meetings, larger office spaces being converted to smaller office spaces. Those are the kind of structural costs, or mix of physical travel with e-travel. Those are the kind of changes which are happening, which could structurally change the cost structure, but not to a great extent. Ultimately, employment is the largest part of the expense part, and that hopefully will continue to drive productivity there.
Okay, so continuation to this, basically the question was to how to build margins going forward, given the fact that you have reported strong numbers. Is it fair to assume that your margins going forward will be better than what we have reported in past years, which is 14-odd%? In F16 was one of the best years. So is it fair to assume, or it is some insights there if you can share?
See, margin. Frankly, margin is a culmination of the sales growth, the contribution margins, and the expenses. So it will be difficult for me to comment whether it will be 14% or 12% or 16%. We are focusing on expanding market share. We are focusing on increasing sales. right? We are focusing on improving efficiencies in the markets in the product categories for better contribution margin. And we will continue to, keep costs under a tight control, whatever right costs have to be done. So, and we are a mix of many product categories. So please don't hold me on to me, making your work easier of making your analyst reports by taking a number from me. You also work hard on it.
Sure, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Hi, Anil.
Hello, Bharat ji, कैसे हैं?
एकदम मजे में कैसे सर? Anil ji, would you say while pandemic is a rude interruption for everybody in lives and in businesses, but in a way when you think about it, probably this may be a blessing in disguise for Havells in kind of reimagining our business model, cost structure, distribution, diversity, product portfolio, and all of that. So in a way, whether this adversity is actually a long-term benefit for Havells, would you think that, or what would be your thought?
I think Bharat bhai, होता क्या है कि when you see markets which have always grown, sometimes आपकी नजर भी एक ही तरफ लगी रहती है. So I think such rude disruptions, though at a very high cost to the world, are sometimes a good wake-up call for people like us. Where you need to you think that your companies are very resilient, but you need to even go deeper and to ensure that your companies are really institutions which, become strong, whether it's a good time or a bad time, you remain strong. So I think this first couple of months when the pandemic happened, when, we saw factories being closed, each and every shop remaining closed, no sales. I think it was something which was never expected in the last 100 years or probably in the next 100 years. So it gives a rude shock to everyone to see where your efficiencies lie. And I think only this kind of a shock could have, woken us up or anybody else in a growing economy like India. So yes, I would say that it has improved us, and we need to, maintain or continue with these gains that we have. I keep referring to good costs, bad costs. Certain bad costs which have been taken out should not come back. Good costs need to come back. Efficiency, focus on productivity, focus on competitiveness, focus on, so many things which actually make a company strong and an institution for a long time. But I agree with you that, this kind of a shock has woken up the industry.
And Havells, apart from industry?
No, of course, we really have worked hard in looking deep inside each and every aspect. I think last 6 months have been quite hyperactive for all our team members. And I tell you, the way teams have also responded also talks about the culture of the organization, how employees contribute to. I don't consider that it's a reflection only of the leadership, but also how each and every employee comes forward and acts in a very different way. In a time where the entire supply chain was disrupted, how even a warehouse manager or a warehouse worker was trying to ensure that the products reach the customers in time. I think this reflects very well. And so I would say that Havells has done a tremendous job in the last 6 months of serving the customers.
Thank you. The next question is from the line of Charan Singh from DSP Mutual Fund. Please go ahead.
Yeah. Hello, sir. Good afternoon. First of all, congratulations on great set of numbers in a very tough environment. My question is more on the core business. When we see core business, despite real estate being weak, there have been some positives in terms of the growth. But if we have to take a little next 2 to 3 years view on the consumer electricals business, various categories, be it switchgear or be it wires and cables. So how do you see the market growth panning out? We have seen some benefits coming even for organized players, taking share for smaller organized players, or unorganized players getting out of the market, or channel getting deeper. So, but from a 2 to 3 years growth perspective in the core business, how do you see that?
Yeah, I think this industry has seen a bit of a slowdown in the past few years. But again, we need to go back to whether those were temporary losses. But if you look at India as a whole, if you're catering to all kinds of the entire Bharat, of not just India but Bharat, and catering to all kinds of customers, I don't see that there is a possibility of a lower growth in any product category. So we believe that the product categories that we are in definitely has great potential for growth in the next 3 to 5 years. Not only in India, but I think, as Bharat Bhai had asked this question about, what has changed in the last 6 months. Also, I think it has opened our eyes to the kind of opportunity which lies ahead outside of India as well. So there could be many, many opportunities in the global markets to expand exports as well. So I think FMEG industry is definitely in a strong position to have a decent growth in the coming years.
Okay. And so just a second question from my side on Lloyd. So we had, gone through a very disruptive year last financial year, but things got stabilized in terms of our channel, in terms of her now, ready with a very strong manufacturing base where even policy measures are kind of favoring where Lloyd is standing at this point of time. So in terms of scaling up of the market share from here on, stability of the channel for Lloyd, if you can just, highlight some aspects on that. And, for the new product introduction, so refrigerators, what's the kind of, ramp up which we are seeing now going forward in the coming years? Yeah, that's all from my side.
I think I've replied this answer question also, in the sense that the stage is now set. We had not a great last year because of many adjustments that we were making. Today we have the product range, we have the distribution channel, we have the right positioning for the product category. So Lloyd is and also a complete product portfolio with as I said, addition of refrigerators. So I think we need to really look at the coming times, and it's a huge industry. We are playing in a huge industry. It's more than 60,000 crores industry, and I think huge opportunity for Lloyd to grow in the coming years.
Yes, sir. That's all from my side. Thanks for taking the questions. Thank you.
Thank you. We take the last question from the line of Tejas Sheth from Nippon India Asset Management. Please go ahead.
Yeah, good evening. I have two questions. One on the working capital side. I think there are a lot of channel efficiency which has been seen in post-COVID towards receivable management as well as inventory management and leading to a higher cash conversion. How much of that you see sustainable going ahead? Is the channel going to be in this efficient mode down the quarter as well?
Well, to a great extent, many of our channel partners are in channel financing. So for us, it really doesn't make too much of a difference. But we've also seen that there has been efficiency improvement, a number of days improvement channel to the banks. So that is a positive sign. I think it's also a reflection of the fact that people have also cleaned up. The dealers and distributors have also cleaned up their houses. They put that in order. High levels of stocking have been reduced. Because of that, they've been able to collect monies better and pay to the companies in a faster way. I think some of that will be sustainable because, as I was referring to Mr. Bharat Shah also earlier, that, like Havells has looked at any inefficiencies within the company, industry has looked at. Similarly, channel partners, dealers have also viewed their efficiencies into the system, and it doesn't make sense to have very high levels of inventories or high levels of debtors in their system. So we believe that some of these gains will be sustainable.
Okay. Second question on Lloyd. Are there any pockets of growth you are seeing on the regional basis in India for you in terms of market share, as well as in terms of modern trade versus traditional trade? Which trade are we doing very, very well versus peer?
I think this falls not really that much of a difference, but overall, as the markets opened up, like for example, Maharashtra, Pune, they opened up much later as compared to other parts of the country. Eastern part of India, Calcutta opened up much later. So we see variations there. But that is for the entire industry and not necessarily for Lloyd. So going forward, I think, when the markets come back to normal, all the markets should grow in the manner of market share strength for the brand.
I went pre-acquisition, the Lloyd brand was very strong in Eastern India as well as in Gujarat market, as well as very strong in traditional trade versus modern trade. If you can tell me how that composition has played out post the changing of the whole structure.
No, I think the stronger areas have sustained very well, like for example, Gujarat, Andhra, Maharashtra. Actually, Lloyd, unlike Havells, was very weak in the eastern region, and that's come up very well after the acquisition and the changes. But the major change has come in the proportion of the presence of modern format retail and regional retailers as compared to pure distribution. So that, as I said, that almost 95% of the sales used to come from distribution, which is now down to about 65%, and the rest is coming from the other channels.
Modern. Oh, okay. Yeah. Thank you very much.
Thank you. That was the last question. I would now like to hand the conference over to the management for closing comments.
Thanks everybody to attend the call, and we look forward to keep engaged. Thank you.
Thank you. On behalf of Prabhudas Lilladher Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.